So good morning, all. Nice to see you. I can't remember how long ago we started doing these calls, but it's been a long time. I feel like at least 10 years or 8 years or 9 years or something in that neighborhood at least. I don't know if Deb has a better memory than I do, but it's a long time.
It's been a while.
Um, and I have to tell you, it's funny. I think if you're fortunate enough, like we are, to work for a great organization like the Vermont Community Foundation for a long time, and we've been here for actually 20 years now, I guess you're just ultimately doomed to have a year like this year. It's been a very difficult year for the portfolio. And I'll talk about that a little in a few minutes. Oops, getting some background noise there. Is that me?
So I think at this point, maybe people just mute your lines if you're not, so that way we won't get feedback. And if you want to ask a question, just unmute. Let's see if that might mitigate that feedback, Mike.
Okay, great. It sounds better now already. Thank you.
Okay, thank you.
So you're always, unfortunately, doomed to have a difficult year along the way. We've had very few. I'll show you this in a minute. And the important thing is to, of course, and we'll talk about this a little bit later in more detail, is to ask yourself, well, what happened? What did we not get right? What did we get right? And capital markets can be very strange beasts at times, as we're all seeing this year with their volatility and their lack of, necessarily connection to reality. And so sometimes you're doing actually a lot of things right, but the markets just don't agree with you at a moment in time. And that's where we get to Deb's point earlier about the long term and thinking about what drives returns long term here. What are the things we think we can get right? What are the things that we don't think we can get right because they're too difficult to know? And so I'm going to walk you through a lot about today, but I'm also going to spend some time on, frankly, the second biggest, or it's a related mistake, I would call it, I'm saying mistake in quotes, that we've made, which is we just don't own a ton of Apple, Amazon, Facebook, Netflix, et cetera. And we're going to talk about that and why we're not really worried about that problem, but it does not make us look particularly successful at the moment. So with that said, here are the returns for the various pools. And so you can see the point I was starting with before, which is this has been a rough year for us. Now, the only good news is if you went back 4 months ago and looked at the returns, we had double-digit losses in the long-term pool and the SR pool, and they were also behind the benchmarks, which was disappointing. So now we've kind of come crawling back or clawing back to a negative return for the long-term pool, which is still behind the benchmark. Although I will tell you, I'm glad to say that that gap is starting to close and through September into early October. And the portfolio right now actually is down less than 0.5% year to date. And it's also closed the gap to the benchmark modestly, but we still have some work to do. So, and you also see the way that is stretched out all the way out to 5 years of return, where we're now behind the benchmark. Now, all that damage, though, I'm going to show you this in a minute, didn't occur over the whole 5 years. We've actually underperformed only for about 18 to 20 months. But that has been severe enough to cause the 5-year return to be below the benchmark. And then you get back to the 10-year, the 15-year, and actually I can't do math this morning. We've been here for 18 years. Sorry about that, not 20. This year feels like 3, I guess. But with that said, and you can see the long-term returns have been very, very strong here, even with this period of weakness. But we'll talk a little bit more about the weakness in a minute. The SR pool actually has been the stronger performer, particularly over the last 3 years, and that's a function of a lot of different things. One is it's a much less complex portfolio, and some of the complexity in our portfolio in the long-term pool has created issues. That's things like hedge funds, things like private assets. The SR pool actually has the benefit of having a lot more, sorry, getting that background noise again, a lot more in bonds. And bonds have done an unbelievable levitating act this year, as you know. I mean, by that, I mean rates dropping as much as they have. It's been really stunning to watch. And so the SR pools had that advantage. It's also had more of a growth orientation, a little less of a value orientation. That's also been very helpful. So there have been, if you went back 3 years ago, I'm sure we spent some time on a call or two talking about why the SR pool wasn't keeping up with the long-term pool. And now we're having the opposite conversation. And I can assure you 3 years from now, we'll probably be having yet the opposite conversation again. And I think the bigger question here and point is that they're both extremely well managed pools with very different objectives and criteria that are used. And it's fascinating to see how the returns can deviate just because of the differences in the way you would structure a values aligned SR pool as closely values aligned as that one is. And then the midterm pool, as you may recall, is intended for shorter horizon investments. And this is another one where the portfolio returns have just been stunningly high. We did not forecast these kinds of returns because we did not forecast interest rates dropping to 0.6% on the 10-year Treasury. And that's what's happened. That's what's driven so much of these returns here. And let me just stop for a moment. I know Q&A is a little tricky on Zoom, but if anyone wants to jump in with a question before I move on, I don't want to move away from this too quickly.
Mike, there was one question in the chat, and they said, what benchmarks are we using for the 3 portfolios?
Yes, good question. So I skipped right by that. So the long-term benchmark, the SR benchmark, the midterm benchmark we're listing here, these take the strategic asset mixes, stocks, bonds, et cetera, of the portfolio and assign standard index funds to each piece. So for example, we have a certain amount in US large companies, the S&P 500 is the benchmark for that. We have a certain amount in bonds, the Bloomberg aggregate index is the benchmark for that. So they're essentially weighted to the asset mix of each portfolio, the goal of which is to say, okay, you're paying Colonial as an advisor. By the way, this is the last time you'll hear me ever say the name Colonial. Our name is changing as soon as next week. That's when the announcement is, excuse me. I lost my train of thought. Oh yeah, so how you're paying us as an advisor and you're paying the managers. And the question is, are these returns, is it worth it? And so you can see when you look at the last year, you'd say, nope, shouldn't have paid anybody. We should have just put the money in the benchmark or maybe something else that would have done better. But then when you get out to 10 years to say it's actually a very big difference, and all the way out to 18 years, it's a massive difference. 1.2% per year times 18 years is a gigantic amount of outperformance. And that is net of fees. So that's important to think about. That's what's been generated by the committee and the foundation over the years with our advice. So those are those benchmarks. They're custom, but they're very competitive over time, and they are index funds, to answer the question. And I'm going to a little bit later, if you don't mind, show you those strategic mixes, and I'll kind of come back to the benchmark question then, if that's okay. So this chart was meant to sort of address, forgive me, you look at this and you say, wow, you guys have had a horrible 5 years. And I would say, well, it hasn't actually been a horrible 5 years. It looks like a horrible 5 years right now. And horrible is probably too strong a word, but we've underperformed for 5 years. And here you're looking at the performance of the portfolio compared to that same benchmark. So the way you read this graph is this is every 3-year period from 2002 to 2020, August 2020. The black line in the middle, that's essentially the benchmark. So we're neutralizing the return versus the benchmark. And so when the blue line is above the black line, that means the portfolio is outperforming on a rolling 3-year basis. And here you can see my point from earlier, which is, now I'm get the math right. We've been here 18 years and we've never had a period like this. And you can see that gigantic cliff dive on the right side. That's the COVID pandemic hitting the market. And hitting the portfolio extremely hard. And I'll talk about that in a second. But for now, we'll just say we own a lot of diversification around them, have a lot of diversification around the world. We own both cyclical businesses and growth businesses, and you really just want to own the growth businesses. And you really want to own those big tech companies in particular. So we have missed out on that part, but again, I will tell you, I'm going to leave you with a word of optimism. We actually have not been through a period like this before for the Vermont Community Foundation, but that's only because we were hired in 2002. If we'd been hired here in 1997, we would have definitely been through a period like this, because 1997 to 1999 was the last time we felt this stupid. And that was the presage to one of the best periods of outperformance we ever had as a firm, which is the early 2000s. And that's because the market is setting us up for exactly that scenario again, which is why we're both annoyed that we have to show you these returns and disappointed with them, as I'm sure you are, but super excited about what's going to come next. So as a reminder, the strategy is very simple. I earlier mentioned the idea that we do not try to do things, we don't try to do things where we don't have a good chance of being right. And so just to give you a quick set of examples, for example, predicting the length of the pandemic, predicting where interest rates are going to go, predicting how the presidential election is going to affect the markets and anything else in the short term, those are incredibly important things. And I'd love to know what their answers are going to be too. But those are things that we don't have any advantage over. We don't know something other people don't know. We don't have any insights that would help us generate higher returns for you. So what we focus on are the things we can get right. And there's really 2 or 3 of them. One is think long-term. We're in a world where that is shockingly absent today, but it's still very important. And so being diversified, thinking long-term and avoiding short-term forecasts has always been our winning formula. It doesn't look wise in 2020, but it is wise, and it will prove to be wise again because it always does. And I'm going to take you through some of the logic of that a little bit later. But these are the key principles that we have always followed. Our firm's been around for actually 40 years, and I've been there for 34 of those 40 years. And this slide, I don't think we had this slide 34 years ago, but we might as well have, because this is the way we do things, and it really does work over time. So if you look at conditions today, this is for so many reasons, and I can't possibly exaggerate how difficult this time has been. from our very narrow perspective of looking at the markets, the range of economic outcomes from here are truly stunning. You can paint out a picture of a deflationary climate, which is where prices fall. You can paint the picture for an inflationary climate where you have prices rising. Most of us don't remember, but it used to happen. And you can also paint out a picture from the 70s of a stagflation climate where you have rising prices without economic growth. So I can't think of a single time in my career where the economic outcome, the range of outcomes, was as large as it is. And that's why the markets are behaving as they are to some degree. The second point is not insignificant. There's a lot of volatility out there. We're seeing markets react extremely erratically to a lot of things. Some of it, almost everything starts out logical, but gets to an extreme that makes no sense. So there's a lot of leverage in the world. There's a lot of computers trading. There are fewer fundamental investors, and now we can add on the Robinhood Barstool crowd, which is actually moving markets, which is just fascinating and will be tragic, unfortunately. And then last but not least is an exceptionally difficult period for us all as human beings, which doesn't, at the end of the day, that it cannot be, that probably should have been the lead, not the last line here, but this is all leading to a very complex market climate. And again, you look at all this and you say, what should I do? And our answer is you should stay focused on the long term, own good things, be diversified, don't pay too much for them, and let time take care of these issues. And then there'll be new issues, of course, that come down the road for us, unfortunately. So here are the mixes of the three pools. And I mentioned earlier, I want to just come back to the benchmarks. So if you'll see, so if you thought about those custom benchmarks, you just look at the top line. U.S. large mid-cap equity is basically the S&P 500 is the benchmark for that. So for that custom benchmark you saw before, 11% of that benchmark's in the S&P 500, 5.5%, this is the long-term pool, 5.5% in the Russell 2000, and so on down the page. The SR pool has 19% in the S&P 500, as does the midterm pool, and so on down the page. You can also see that the SR pool has about 30% of its assets in fixed income versus 21.5% for the long-term pool, and the midterm pool has 47.5% in fixed income. And if you went back to that first page and you saw how much better the returns were, particularly in absolute sense in 2020, that line tells you everything you need to know about where those came from, because the bond market was up a solid 8 to 10% to start this year. And so that's a very important factor. I think my screen dips down when there's a chat question. Debbie, should I stop here for a question?
Sorry, I had to unmute. You made a comment about the Robinhood Barstool crowd, and I think people were wondering what that was.
Oh, sorry. So Robinhood is a trading platform. In fact, what we'll do, if you'd like, well, let me answer the question. I'll tell you something I'd like to say too. Robinhood is a trading platform that was created a bunch of years ago, and basically sort of turns the concept of investing into a bit of a casino. And what's happened is just the way their app works and the way things work. And they were the ones, by the way, to their, I think credit's the right word, I'm not sure, that came up with commission-free trading. They started this idea basically, which attracted a lot of investors, particularly smaller investors. And that was all fine. They actually drove prices down for investors. You can argue that was good. But what's happened in the pandemic time is Barstool is a website, I guess, or blog. I don't know how to describe exactly, which is, I can't even describe it because it's not something I'll say something that will be offensive to somebody, so I won't, but it's a little bit it's more than a little offensive actually. But it was started by a guy who sold his company to a gambling company named Penn National Gaming. And so his name is Dave Portnoy. And so Dave Portnoy has been tweeting that he is smarter than Warren Buffett because he's made more money the last few months than he has. And he's basically advocating for day trading. And so what's happened is there's been literally a surge of signups to Barstool, probably not to Robinhood, basically. And so there's a gigantic army of what they call Dave Portnoy's day traders who are really moving markets. It's fascinating to see that a lot of relatively small investors are doing it. So that's what I was referring to. It's kind of the 1990s rise of day trading is back, but this is even worse because it's the internet fueled zero commission version of it, where you could literally, if you ever download Robinhood, you'll see on the app, it makes it into look like a game, but it's not a game. It's people's money. It could be their savings, it could be their retirement. It's actually quite frightening. And I'll just give you a quick example. which is when you sign up for the site. I'm not a user, just to be clear, but when you do sign up for the site, it asks you a bunch of regulatory questions, like, are you working for a registered broker dealer, et cetera, et cetera, et cetera. And then they help you along in answering those questions by saying, if you don't understand these questions, the answer is no for you, which again is not really, that tells you something about the way the whole thing works in terms of the level of sophistication. But the sad thing is that this has also led to people trading options and doing all kinds of really aggressive things that really require that you know what you're doing. And so, it's just that's what I was referring to. So last thing I wanted to say was before is we write a commentary every quarter. And the one that we're about to write for the third quarter, we have written, actually, it's just not, even the committee hasn't seen it yet because it's not third quarter reporting yet, but is about Robinhood actually, and about how they kind of take advantage of investors. And so we'll, maybe Deb, we can make that available to anyone who wants to see it on the call here today. Sorry for that long-winded answer, but it's interesting. And by the way, I don't want to make it into the thing. It's not the thing. It's just one of many things going on in the markets today, which are different. And we'll, like everything does, they come and they go. So as we think about the portfolio, so first of all, we don't have a Robinhood account, just to be clear. There's no one day trading in the portfolio. That's not something that anyone's going to do with your assets. But there are four things we think about quite a bit. One is balance and patience. Patience actually is something we haven't had to have that much of around here from our perspective, which is that when the portfolio is doing well, you don't need to be patient with it. So right now, everyone's being asked to be very, very patient. And we're walking the fine line of trying to also be patient, but also make sure that when we make mistakes, we fix them, we change them, and we do things right. The second thing, as I mentioned earlier, and I'm going to come back to this in a minute, but markets are offering one of the most extraordinary opportunities ever that we have seen since 1999, frankly. This is almost as good as it gets. Sadly, though, when I say things like that, I'm also saying something very negative, which is that someone's going to be on the wrong side of that. And it's going to be very ugly, unfortunately. There's a huge trap set for those who ignore price. And then last but not least is to ignore noise. And God, to say there's noise would be the understatement of the century. There's an ongoing deluge of information that is actually very important to everyone's day-to-day lives. I'm not being remotely dismissive of it. But at the same time, when you're a long-term investor, you actually do have the luxury of looking past those things as long as you're diversified and rigorous in the way you do things. And you think about the fact that bad news delivers what we call asymmetric opportunities. And what that means in English is that when something happens bad, a bad thing happens to a basically good company, you have price falls, of course, quite a bit. And you have, at that point in time, very limited downside, assuming it's actually a good company, and gigantic levels of upside. And so the portfolio is filled with people making those kinds of investments. I'll give you a quick example, if you don't mind. We have a manager in the portfolio who has a very concentrated portfolio of investments. They only own about 8 stocks. And so back in March, when the pandemic hit and everybody was absolutely in a justifiable panic, he had a position in a company named ASOS. ASOS is an online fashion retailer based in the UK. And he took that position because the stock dropped, I can't remember what it dropped, 50, 60%. He took that position up to a gigantic part of his portfolio. And since that time, because his argument was that it was so cheap, it couldn't drop much more for any period of time. And the upside was massive. And fast forward to today, the stock's up 450% and has generated a massive return for the foundation. So we would have argued, and he'd agree, the downside of that stock was 20, 25% from when he sized it up. And the upside was actually 450 is what we've seen. And actually what we also think is true, and he thinks most importantly is true, is the upside is still quite significant from here. That's how unbelievably cheap it had gotten. So that's what we mean by asymmetry. So I keep talking about what we haven't done and what the risks are. So let's dive into this for a moment, if you'll bear with me. So this chart at the top of page 8 is looking at the 5 largest stocks in the S&P 500 and going all the way back to 1990. So now it's not always the same 5 stocks, but whatever the 5 stocks were that were the biggest part of the index. So the S&P, for those who don't think about indexes all day, is what we call capitalization weighted, which means the size of the company determines its weight in the index. So if a stock was so that's the point. So if the size of a company, which is its stock, its shares outstanding times its price, is a certain percentage, that's what it is in the index. So when you look at this graph, so what the stocks were, it doesn't really matter. But when you look at this graph, back in the late 90s, again, the beginning of our dream period, the top 5 stocks in the index were 18.2% of the index, which was at that time the highest level it had been in a long, long time, because at least all the way back to 1990, which is only 10 years. Now, fast forward to today, you'll see what happens is that the concentration in the index dropped, and now it's soared back up to 22.1%. So that gigantic leap, which actually a lot of it occurred in 2020, as you can see, are the 5 stocks below. Apple, Amazon, Alphabet, Facebook, and Microsoft. Alphabet, for those you don't think about, is Google. And so those 5 stocks are the top 5 stocks in S&P. Now, they haven't always been, just to be clear, but they are now. And they're now almost, well over 20% of the index, which, by the way, doesn't make the S&P 500 a bad idea per se. They're still 78% in other stocks. But what we are saying is that these stocks have some questionable issues going on right now. And I'm not even talking about, their place in society per se. Take a look at the middle column. So this is what we call the price earnings ratio. So this takes the price of the stock and divides it by its last 12 months earnings. So at the end of last year, you can see those ratios where they were. Now look at the second column, which is where they are today. So essentially Apple, which is clearly a very dominant company, no question, but investors at the beginning of the year were willing to pay $22 for every dollar of earnings that Apple earned. Today, they're willing to pay $35 for every dollar of earnings Apple earns. Amazon was 77 times, so $77 per share for a dollar of earnings. Today, it's 122 times. So what that means in English is that people are willing to pay more and more and more for a dollar of earnings from these companies, with the exception of basically Facebook. And the reason is because they think that these stocks are the category killers and they're going to be basically huge long-term winners. Now look at the profit growth on the right side of the page. And for the most part, these companies have grown at very fast clips over the last 3 years. Notably Amazon being the biggest, Alphabet actually not really that big, but good. And then Apple actually not growing that much at all, frankly, which is interesting. But my point is that investors are getting very, very, very optimistic about these stocks. And that's what happens when a price earning ratio rises the way you're seeing here. So you've got this issue where more and more of the S&P 500 is in 5 stocks that are incredibly popular. And so that's just an interesting thing. So let's just put that aside for a moment and go to the next slide. So let's go back to my dream period, or the beginning of it, which is what was that like in March of 2000? So here are the top 5 stocks back then. Microsoft was still there, which is interesting. We'll come back to that in a minute. Cisco, General Electric, Intel, and ExxonMobil. By the way, all of these stocks are still around, as you know, these companies are still around. And what's interesting is look at their ratios, which are actually quite similar to the ratios, the price earnings ratios we see today for some of the stocks that we have that are our current darlings. And let me be clear, back in 2000, there was as much excitement about these 5 companies as there is about the 5 companies we see today. Now take a look at the far right-hand column, which is what did those companies generate in terms of growth? So 10% from Microsoft and Cisco. GE actually hasn't grown at all. They've lost money. Intel's grown 6.5% per year, and ExxonMobil's shrunk 2.1% per year. So it's kind of interesting. One of the things I'm going to talk about in a second is how much can a big company grow? Because if you're already a gigantic company, how much bigger can you get is a real interesting argument, right? So for example, Microsoft was a huge company back then. Cisco was a huge company back then. And the fact they grew 10% per year is really stunning. Actually, it's extremely impressive, particularly if you think about the fact that the US economy grew 2% per year. So if you're growing 10% and the economy is growing 2%, you're just becoming a bigger and bigger and bigger part of the economy. And as Microsoft discovered, and every company discovers at some point, you can get so big that a whole bunch of risks start coming up, like let's break you up, like we need to put special taxes on you, that you become a public policy threat, essentially. So the point is that those 5 stocks did that. Now, you might say, all these companies are still here. I mean, those who haven't looked ahead, I'll show you in a second, but you could say Microsoft's still a great company. Obviously, Cisco's still around. GE, Intel's still a great company, but take a look at this. These are the stock price performances from March of 2000 through, we did this the day before the end of the month, but it hasn't changed, obviously. So the S&P is up 122.6% over that period of time. Microsoft's up 290%. I'm going to come back to that in a minute. So that one's done very well. But every other stock here has lost money. Cisco, GE, Intel, and ExxonMobil. And let's just stick with, for the second, Cisco and Intel. I mean, these are both very successful, dominant companies to this day. And I can assure you that no one buying those stocks back in 2000 thought they were going to lose a quarter or half of their money over the next 20 years. This is price change only, not dividends, just to be clear. So my point is that this is what happens when you don't pay attention to valuation or you pay too much for something. Nobody can keep growing forever. Today's darlings, will not be the darlings 10 years from now or 20 years from now. And even an example of Microsoft, we say, well, doesn't that defy everything you just said? They were a darling in the past and they're a darling today. And the answer is, nah, it's a little more complicated than that, which is this chart. and this is one of my last ones, and I'll stop because I think we had some questions. This takes a look at Microsoft's stock price performance from March 2000 compared to the S&P 500. So the S&P 500 is the red line, and that Microsoft is the blue line. So what's interesting here is Microsoft, you'll see, is actually underperformed the S&P cumulatively all the way until 2018. And that occurred because the company went through the normal things that a big company goes through. And then in 2016, 17, the management changed. They refreshed the business. The whole business has been kind of retooled with a new CEO and a new strategy. And they've kind of come back to life, which is this gigantic surge you see on the right side of the graph. But if you go back here for a second, those who paid 66 times earnings from Microsoft in 2000 were not banking on 18 years of underperformance before they finally got to say, oh, we were right. That's definitely not the strategy. So my point I'm trying to leave you with is that three things. One, disruption is what leads to the new darlings of a market. Disruption doesn't change because they've now won for the moment. Things change again, and company leadership changes. It always does. It always will. And two, what always happens that somewhere at the near the end of a cycle is people get so excited that they're willing to take a gigantic company like Amazon and pay 122 times earnings for them. By the way, when they're already experiencing some of the benefits of the pandemic in these numbers, right? For them, the benefits, I should say, as are all these stocks. So these are nosebleed valuations. Just to give you one last data point on this, the average stock historically trades at about 15 times earnings. And the other ratio we use in this business sometimes to decide what a stock is worth, this is oversimplifying it all, but if you trade at, we have something called a PEG ratio, which means that the price earnings ratio should basically correlate to the growth. So if you had 20 times earnings, your earnings should grow 20% per year. That's the old ratio that gets used. So Amazon at 122 times earnings needs to grow 122% earnings-wise per year for a long period of time to get that. And I'm not even going to pretend to do the math, and that's insane. They'd be bigger than the entire world's economy in like 9 years. And so that's just not going to happen. So my point is that the darlings always change and price always matters in investing. So let me stop because I do think there might have been a question or two, Debbie.
Let me take a quick look. I think one was answered. And then a question from Steve was talking about, again, focusing on our style. And I'm just kind of summarizing it. Mike, you can read the details, but it basically saying, are we contemplating any adjustment in style and or allocation, for example, the value at this point in time? So it's really looking at a rotation away from growth towards value and international. And because of some of the activities that's going to come up in the future, would we be changing any of our style and our investment strategy?
Yeah, no, but I'm now reading the question. So we're waiting for that style of rotation to be clear. So we're not changing our style or our strategy. I also don't want to leave anybody on this call with the mistaken impression that we have just basically a big, gigantic value portfolio. That's all we like. We actually like growing companies. We think they can be extremely interesting investments. We own a bunch of growing companies in the portfolio, but what we won't do is pay 120 times earnings for a gigantic company that can't possibly grow that quickly in the future. So we need to think that our investments will do well. And a lot of the ownership of big companies is just that they're doing well and people don't expect anything to change for them, which is always a trap that people fall into. So we're not changing our style, but I will tell you this though, if we do get the rotation that is being referred to in this chat question, that will basically have the portfolio rebound even quicker than we expect and will give us a huge, huge tailwind. But with that said, even if it doesn't happen, and let me just give you an example, over the last 5 months, the portfolio has actually started to outperform, and it's done so without a rotation to value. And that's because people are buying ASOS in the portfolio. And my point is we need to and will have multiple ways to win. We're not going to make this all a monolithic singular thing. So we're not changing the style. We're always thinking about how to win, even if value stocks don't come back for another 2 years or 3 years or whatever the case may be. But that's what we're looking at. And we'll see what happens, of course, there.
I didn't see any other questions in the chat box. So are there any questions out there from anyone else that would like to jump in and ask some questions at this time? And just remember to unmute yourself if you muted.
And while you're thinking, I'll just cover this last slide real quickly, Debbie, which is our strategy has not changed. Like I said, all these years of having to just basically having the pleasure of giving you all good reports, we now have a weak report. I don't that many weak reports, just to be clear. I'm very optimistic. But there are three basic tenets of this strategy. One is to be consistent. So that question before about style and international was really important because it's tempting to try to guess what will happen next in the market, and that's what strategists do. But we don't do that because we just don't think I've never understood how it works. And also, this portfolio is a battleship. You don't move hundreds of millions of dollars around quickly. You should do it wisely, and so that means we can't be too reactive. So we're very consistent. Two, volatility is our friend. I know it's really unpleasant and no one enjoys it. And Debbie and I had some very unhappy conversations earlier this year when the portfolio was down as much as it was, because it has real implications on the foundation and on grant making. And we both knew things would be fine, but it's just not fun and it's difficult. And so we don't like it, but we know it helps the long-term returns of this portfolio. And going back to those 10, 15, 20-year return premiums, volatility was one of the things that led to those outcomes. And then the last thing I want to be really clear about is the concept of scale. The Community Foundation has a large asset base, and we have access to some incredible investors that are not widely known to the public or known at all. And they do an amazingly good job for the foundation over many years. We also use index funds, and we believe in a lot of different diversification. But my point is that this ability to access top managers across a diversified asset mix has been the secret sauce for 10, 15, and 20 years. And it doesn't look like it's been very smart for 12 months, but I can assure you, I'm not sure it'll be 12 months from now or 24 months from now, hopefully no longer. We'll all be looking back and laughing, oh, that was a really weird blip we had back in 2020, because that's what this is going to be. I'm going to make that statement.
I like that statement, Mike.
Thanks.
Okay, let me just see if anything else popped up here, guys. Okay. All right. So I think at this point, we haven't had any other questions at this time that I wanted to share. So anyone else, last call for tapping into Mike's knowledge, insight, questions on the portfolio? We will have our next call, I believe, in December. Lots of things are going to happen between now and December. It'd be an interesting call just because the investments will be the topic, but I'm sure there'll be other things that have happened that we'll all be curious to see how it's going to affect the portfolio and all of us in general. So on that note, I wish you all well, stay safe, and always feel free to reach out to us if you have questions or concerns. You can contact me, or you can contact your philanthropic advisor that you have here at the foundation. Thank you so much for joining the call, and it's so nice to see people this time rather than Mike and I usually stare at a black box, and so it's nice to see faces on the other side. So thank you for joining us today.
Yes, thank you.
Bye-bye.
Bye, everyone.
Thank you, everybody.